Hello everyone, thank you for joining us once again for the third webinar in this QuantMinds DigiWeek series titled Corona Immunise Your Portfolio from Global Macro Trends to Corona-Proof Quant Investing with Svetlana Borovkova. My name is Vincent and I'm the editor for our RiskMinds and QuantMinds international brands. So before I hand you over to Svetlana, I would like to share with you how you could make the most of this webinar and importantly how to submit questions to us. So if you hover over your toolbar, you will see an icon that looks like a speech bubble. When you click on that, you will see the option to submit your questions on the side of your screen. I'd like to encourage you all to submit your questions throughout the webinar, and we'll address as many of them as possible at the end of the presentation. And if you know of people who couldn't make it to the presentation but are interested in the content, the webinar will be available on demand this Friday in our upcoming e-magazine. Now, I'd like to welcome Svetlana Borovkova. Svetlana, the floor is yours.
Thank you very much, Vincent. Thanks for invitation and thanks for everyone tuning in. Although it's a QuantInvest sort of digital event, digital week, my presentation today is anything but quantitative. So maybe that gives you a little bit of a respite from the heavy quant stuff that you had from Alexander Antonov and yesterday and Mr. Prado day before. So I don't think there will be a single formula here today, but it doesn't mean it's not worth listening to, I hope. So I'm going to talk about trends that we observe in the current situation, you know, after in the, let's say, the Corona crisis, and thinking aloud about how our world is going to change and what it means for portfolio management and for asset management. First of all, I'd like to thank my lovely team who participated in this research and still are. Their names are here, and so let me first tell you a little bit about our plan for today. So I'm going to talk a little bit first about different alternative data sources. So one of them where I work a lot is sentiment in news and in social media, and I'm just going to show some interesting observations that we have seen in the last few months. Then I'm going to talk about these emerging trends that we see and that we are able to, let's say, verify with the help of alternative data sources. And then I will proceed on how you can make use of those trends to select stocks that would hopefully immunize your portfolio in the post-corona world. A side issue perhaps is a sustainability, and which was of course at the front mind of all investors before the corona. So what is the situation with that now? So how are sustainable versus less sustainable firms faring this crisis? And if I have time, I'm gonna just mention a little bit of how we are thinking about another interesting phenomena that we never seen before, and that is negative oil price, and how we help out people, our customers, and also from the, let's say, more academic perspective. So how can we think about this new phenomena? Okay, so I will start with something which I actually published on LinkedIn on February 21. So we monitor sentiment, news sentiment related to large cap stock markets. Among others, sentiment related to S&P 500 firms, and we do it in real time. So around about end of January, so January 21, we have noticed that the sentiment indicator that we construct ourselves from news messages all over the world we noticed that the sentiment indicator has shown rapid and sustained decline, which looked almost nothing like as bad as we've seen in the last few years. And this decline was completely not reflected in the price moves. So we were thinking, you know, what is going on? And, you know, alarm bells were ringing basically when we saw that. So, and of course, in February, the COVID was not yet, you know, at the forefront of everyone's mind. However, of course, we suspected that this had to do with COVID. So then we ran the mentions of COVID, coronavirus, corona in the news, and we saw that this sustained and rapid decline indeed coincide with mentions of those terms. And so our suspicions was verified that it's coincided at least with sentiment. So, however, the stock markets has not reacted until very long time. So at some point, you know, the news basically sunk in, and it was 3 to 4 weeks after the onset of the decline and the sentiment related to the stock markets. And then, of course, the sentiment and stock prices started tumbling down in sync. So that was a very interesting and very powerful sort of evidence of how sentiment is useful in signaling those large risky downturns for investors, especially, but for all of us in financial world. So now the question is how things are faring now. So this is up to Tuesday. As you see, the sentiment significantly recovered, and while the decline in sentiment usually precedes the decline in price, the raise in sentiment actually follows the raise in prices. So that's an interesting observation, but it's not a new one for us either. And so now we see again some dip, and I think from now on this is kind of the new normal, where the sentiment is actually negative or almost negative, something we have never seen before, never even during the crisis of 2007-2008. So just this simple illustration shows just how alternative data such as news messages, social media, sentiment of all this content can help us, for example, to signal significant stock market declines. And this is not, by the way, restricted to stock market as a whole, but this can go down all the way to sectors, to industries, to individual companies. So using this kind of powerful news source, powerful alternative data sources such as sentiment and also other, which I will mention later on, for example, Google and other internet searches, so Google Trends, which I'm going to show some example of now, but also things like sustainability scores. So using all this alternative data, we can do interesting things in terms of analyzing our investment portfolios, improving them, and doing it dynamically throughout crises such as this one, and as well in light of emerging trends. So using this alternative data, we identified 3 main trends that we see, which also I think will be with us post-corona. So one of them, I will describe them in greater detail in a minute. And here I just mentioned them. It's a social transformation, accelerated digitalization, and sustainable innovation. So I'm not saying these are the only 3 trends, but these ones that we observe more significantly, we find evidence for them in our own, let's say, intuition and talking to people, but also from quantitative evidence from alternative data sources. And these 3 trends, we think, encompass quite a lot of what is going on and what will continue to going on even when this situation kind of calms down. So let me go one by one over these trends. So the social transformation is, I didn't want to call it social fear because it sounds so negative. That basically stems from increased awareness and, let's say, indeed fear of social gatherings or situations where infection and disease can be, can play an important role. So this trend is characterized by things like cautiousness in travel, in mass gatherings, but even in individual social contact. But then it trickles through towards other aspects of, let's say, consumer behavior, urban development, transportation, and so on. So, for example, it's an increased interest in staying and buy local. It's different ideas about public spaces, something which is now very much also in media. Increased car and bike use over public transport, as well as increased level of hygiene and higher priority towards healthcare. So you can illustrate, or let's say find evidence for this trend in many different ways, studying sentiment. I'm going to show it to you on the example of Google Trends, however. So these are Google Trends related to things like travel, and especially like local travel, which increases, but in terms of global travel, the Google searches of that are significantly decreasing and showing actually no sign of increase again, while, for example, cruise ship industry is completely out of the picture, even from this simple data source. Another interesting example is food and services related. So I'm just showing here a few search terms, but there are actually myriad which you can investigate to find, let's say, evidence for trends such as the one I've just mentioned. So interest for preparing home meals, and declined interest in going out, but also like local. Again, if you add, let's say, local produce and sort of stuff like that to that search terms, you see a gigantic spike in this kind of behavior as well. Then another trend is, of course, we are in the middle of that trend right now, listening to this online webinar rather than being all together in Hamburg for our conference. That is basically accelerated digitalization. And that is characterized, of course, by that emerging from the long period of working, entertainment, and exercising from home online, and there is a large chance, so almost 100% chance, that this will remain with us also when we are actually able to get together. So this accelerated digitalization is characterized by remote working, remote communication, and then things like remote education, shopping, recreation, sports, less business-oriented travel, so moving all the meetings and conference online as we are doing now, broader acceptance of online solutions and process automation, so the resistance towards doing things online is going down. At the same time, it's a great importance of IT security that we observe, as well as changing balance between the home and the office space. While in the past we were able to accept smaller houses and large, beautiful offices, I think situation now is tending to reverse as we do more and more stuff basically at home. Again, some evidence for this in terms of Google search terms and also other internet resources search terms I'll show you. So web conference and video conferencing having a gigantic spike. So you can also see it, of course, in the success of platforms such as Zoom, which now together is worth more than all largest airlines taken together. You see it also in sentiment-related stuff, but also things like hacking and cybersecurity also is, you can see a large amount of interest towards those topics. In terms of home exercise and entertainment, you can look YouTube searches of YouTube or other internet sources. So here I'm showing you the YouTube searches, and that's for exercise, yoga, and workout. Again, gigantic spike in interest for those kind of topics. Okay, and the last but not least trend that is, of course, has been already going on, but now is given enormous push by those things I mentioned before, but also especially by the rescue and support packages, which are, of course, incredible in their sizes coming from the governments. But these packages are not without strings attached. So the businesses that are making claim on those support packages are going to be required to operate in a significantly more sustainable fashion. So this trend is, I would say, is basically facilitated by these conditions of this government support for businesses, but also in by the consumer behavior, shareholder, customer behavior in the light of a new world as we kind of see it today. So what we see also from these alternative data sources is that fostering innovation will lead to old school, less sustainable companies disappearing partially, and new, more environmentally friendly companies emerging in their place. Except especially because of the emphasis at the moment is on sustainable transformation, which is the hard condition of government support packages for businesses. At the same time, there is a changing balance between customer versus shareholder interests, deglobalization, shorter supply chains, less global transport and import and export, increase in local production, which refers back to the local interest in buying and staying local. And then the shift from growth-oriented to circular economy, as well as demand for more sustainable consumer products. So interesting evidence, I can show just a tiny piece here, and that's, for example, increased interest in solar power in the last few months. So whether it's home improvement or genuine concern against fossil fuels, we do not know, but this is definitely something that you can also see even in more sort of individual consumer behavior alongside of all these government conditions of government support. So what does it mean for the portfolios? So it turns out that the companies can be scored in terms of these emerging trends. And so these new trends can be thought of as new investment factors, because we can score and rank companies according to those trends and then form portfolios on the basis of those scores. Of course, a very easy, a very, let's say, obvious way is just to operate in terms of sectors and say, healthcare and tech sector are obvious winners here, and travel and leisure are obvious losers. But that is, of course, a very simple way of thinking about it, because investment portfolios must be diversified, and they must be diversified across sectors as well. And hence we need to not just sort of focus on those sectors that we think are gonna score well, but also choose companies from other sectors to preserve this diversification, but which are, let's say, more immune and more resistant to the future that will undoubtedly emerge after this epidemic. What we already see is that factors such as quality and sustainability, which are already considered as investment factors, have proven to be valuable in times of this kind of stress. And I will mention that later. And so what I'm saying is that the investment portfolio can be tilted towards these new factors alongside these well-known factors such as quality and sustainability, and hopefully making them more resistant to whatever happens next. And as I said, this goes beyond simple sector selection. However, I'm going to show you some quantitative evidence for the sector resistance to all these things. So how would you score companies like that? So this is the kind of exercise that we are, actively involved with. And it's actually very similar to the analysis that people do, in consulting firms, in banks, in investment firms, but also in central banks and regulators, when they assess the impact of climate change on individual investments, so on individual companies. So this kind of approach is already used in that kind of analysis, so climate change related analysis. And this is also the kind of the philosophy that is possible to apply here. So we can look at critically at companies' operations as well as their supply chain, so upstream and the downstream, and the product and the way they reach their customers and things like that, and identify, so basically pinpoint how it will be affected if and when each of those three trends materialize. And if you believe in other trends, then the same kind of analysis can be done. And in each of these dimensions, so the social fear, digitalization, and sustainable innovation, we basically can assign three scores, green, yellow, and red, sort of traffic light like system, whereby we say high means positively affected, medium, not affected, or maybe affected in a positive way in an upstream and negatively on a downstream, which kind of cancels each other out, or low, which means it will be negatively assessed. So I'm going to show you some examples, and this current assessment is based on a rather high level description, but of course investment analysts would perform a more detailed investigation, go into detail of company operations in the yearly reports, financial statements, and provide perhaps a more comprehensive outlook. So let me give you a few examples. So here is this kind of scoring metrics for, let's say, 10 US companies. So we have them for the entire S&P 500, but here, of course, I couldn't show that to you, but here is the example of them where you basically see, what is negatively, positively, or neutrally affected by these emerging trends. And again, of course, it is a little bit subjective and it's not 100% quantitative, but I'm going to later on show you some little bit of a quantitative results to that end. And so you see that, you can basically choose and pick companies, let's say, that have one or less red block for your portfolio. Okay, so that's one example. So here is an example of similar of EU companies, where, for example, Siemens scores very highly on all the three trends, and typical car company does not. And then things like those semiconductor companies, they contribute to digitalization and so on. And so you can score it in that kind of way. Right. So you can, of course, also look at the industries in exact same fashion by basically averaging those scores per industry. And already here you can see industries that are more or less, let's say, resistant to the emergence of those trends. And of course, as you can imagine, the healthcare is definitely hasn't got any red blocks. Tech also not, and yet energy, for example, consumer staples, that's kind of highly impacted. But I'm going to go through this a little bit more at the end of my presentation, when I'm going to show you how this changes when we look also, when we split the companies by less or more sustainable, and how they feared this crisis, whether there is something different going on from that perspective. Okay, so this is the EU scores per industry. Again, energy is a big loser, and tech, communication, is healthcare are the obvious winners of these new trends. So here is an example of scoring procedure. So the company would get a scorecard, and then the explanation of the scoring is given some guidelines and our criteria according to which companies are scored. So here American Express, so the social distancing, the online thing contributes to them in a positive way. Now here is the BMW situation. So interest in using cars over public transport gives it a green score here predominantly, while they don't actually do much in terms of sustainable investment at the moment, not at least compared to that industry pairs. That's how we always compare, and hence they get red here. And you can go on like this with other companies such as Microsoft and healthcare company. And this is, of course, a very interesting company. So food and Danone, which scores very highly along all three dimensions. Nike. Okay, so now interesting question, which I already kind of raised. So there is a sustainability component in those new trends, right? So there is a third trend, sustainable innovation. But of course, we have been monitoring sustainability of companies already, right? So we already know, well, know in quotation marks, which companies are more or less operate in a more or less sustainable fashion, according to some criteria, according to some metrics. So interesting to see how are sustainable firms surviving this crisis. So if your portfolio is already invested in sustainable firms, are you doing better or worse right now than, let's say, a benchmark? So we used Refinitiv ESG scores and we look, let's say, at top 10 companies with highest ESG score and bottom 10 companies with lowest. And we also look at the individual environmental, societal, and governance scores individually. And we do it both for EU and US. And you can look, for example, at just how much did they suffer? I mean, all financial markets plunged, of course, dramatically and subsequently recovered, at least for some part. But how does that, decline and recovery spreads itself along those different firms? In other words, more or less sustainable ones, and also along different sectors. So here is an interesting graph because it shows in green the returns, so the decline in value of the highest sustainable companies and lowest sustainable companies since the beginning of the COVID epidemics. And this is the overall ESG score. And this is on the basis of E, so environmental, societal, and governance at the end. So if you look at overall, then you see that sustainable companies in terms of ESG scores have lower losses than less sustainable companies. And particularly it is clear in terms of the G score, which is the governance score. And it is well known, and we observed it ourselves, that the G score is highly correlated to the quality investment factor. So this is exactly the manifestation of that fact that well-governed firms, quality firms, their returns suffered nothing like as much as those which have lower G score. While for E score, situation is kind of reversed, but that's of course remains a question why that is so. All right. And another interesting thing is to see how then these firms recover. So although you see that highly sustainable firms plunge into, let's say, crisis with a less speed than less sustainable firm, they also rebound less. So relatively speaking, it all comes to the same thing in the end of the day. So they recover less, but they also have much lower suffering from let's say overall crisis situation. So here is an interesting breakdown for sectors. So this is not based on the scorecards that we did, but on the basis of these returns across sectors. during the COVID crisis, since the onset of the COVID crisis. And so what we see that several sectors emerge, which turned out to be kind of, some are more and some less surprising winners here and losers. So healthcare, of course, we all know that they are, well performing at the moment, especially given the first trend. But interestingly, the industrials, so for example, are doing very badly, and materials are doing not bad at all. So this is an interesting observation, so that the sectors such as materials and energy, so you see energy firms which are highly environmentally friendly did not lose value during this crisis as compared to the energy firms that are not having that environmental focus. And the same holds, for example, for utilities, so which is of course, very much related to energy, that those utility firms that try to operate in an environmentally friendly way have much less pain at this point in time than those that are not more sustainable, let's say. Okay, so these are definitely three sectors to watch, especially for those sustainable, let's say, more sustainably tilted portfolios. Yeah, so this is the energy sector, and that's just basically shows what I told you, that energy sector returns for sustainable companies was nothing like as bad as for those that are less sustainable. So this again, you can write off the entire energy sector in your portfolio, but of course for diversification purposes you need it. And here is the way to tilt your portfolio, so still include energy firms and yet immunize them somehow against these large negative events. And this situation is even more visible for European stocks, where environmental issues are actually higher on the agenda. And for materials, the situation is extremely clear that this is again the situation here. Well, healthcare, although the entire healthcare sector is doing not so bad, those healthcare firms that are also sustainably highly rated are even, doing it even better than the healthcare sector in a whole. So you see the combination of sustainability factor and those new, let's say, trends could actually mean portfolios that could be very resistant in the near or even longer future. So here are some takeaways that I basically shown here. Okay, all right. So I don't know how we're doing on time. Vincent, how are we doing on time?
Yep, we're fine. We've still got now 25 minutes.
Okay, then because I have a little, let's say, something about completely different thing, then I can obviously proceed with that for a few more minutes.
Definitely.
Okay, so to conclude this part, then basically is the observation that the post-corona world will be different, and alternative data helps us to identify upcoming trends. So here I only spoke about sentiment and internet searches, alternative data, but also ESG data. But you can think of other data sources to confirm or deny certain ideas about how our world is going to look like. So those trends that we have identified can be thought of new investment factors, and companies and sectors can be scored with regard to those factors, which then again gives us the opportunity to change your investment portfolio towards those factors. But let me talk now about something completely different, because this is where I basically come from. I come from oil trading. That's how my career in quant finance started. And throughout all these years, I've been still very active in energy price modeling, energy risk, and things like that. So when, plus also, of course, the business activities are also often related to this thing where I'm advising clients on utility clients or portfolio management firms, which also have commodities in their portfolios. So it remained, you know, a big interest of mine. And so when, of course, we observed that negative oil price, then both from my personal perspective, as well as from my company perspective, as well as from academic perspective, things became very, very interesting. And telephone was red hot, and the whole thing just basically exploded, which I thought was a lot of fun. So yeah, you probably all seen it, right? Minus 34, minus 35 dollars per barrel in April 20th for the first nearby contract of WTI oil. It's a perfect storm for those futures. Large drop in supply, inability to quickly decrease the demand, added to that storages at full capacity, and the WTI oil being landlocked and having physical delivery feature. All that came together 3 days before or 2 days before the first nearby contract neared maturity. And traders were basically faced with the dilemma either to basically pay people to take off those contracts off their hands, or pay astronomical storage costs to take physical delivery. And just to give you some perspective, so the cost of chartering a tanker, a typical oil tanker, around those dates were $180,000 US a day, while in the normal circumstances it would be about $13,000 a day. So it's a 15-fold increase in chartering storage facilities. So all that led to this interesting thing, but of course it means that your models, your risk models, or your pricing models basically will crash if they are geometric Brownian motion based or any kind of other positivity constraints are imposed on them. So now the question, So the questions we immediately, of course, got, so how do you help? What does it mean for our risk and pricing models? And some solutions to that need to be done quickly, especially for those risk models which are value at risk expected shortfall based. So here, for example, So for example, here, one thing to do would be to just simply remove the offending futures contract completely from the model and implement a significant risk add-on for it to account basically for not having it in your model at all because of the fantastic return that you observe and negative price. So this is like a duct tape solution, clearly, and something more structural is needed. And especially it is needed towards pricing and forward curve models, which are cornerstone of the oil trading and oil derivatives pricing. So of course, we have an asset which has been negative for a long time, and that is the interest rates, where shifted models, shifted LIBOR and so on, are now routinely used. However, this solution will not work for oil. And I know that companies just basically jumped up and started shifting their models towards this minus 40 barrels per barrel. However, this, I claim, is not a right solution for that. So first of all, because we do not know just how negative prices can get. I mean, this was what we think is a perfect storm, but who says it can't go even lower? I think it can. However, on the other hand, this was indeed this perfect storm, and this drop in demand, an ability of decreased supply, and rise in storage costs produced this significant but very short-lived dip into the negative territory, plus the fact that the futures were expiring. However, we do have a commodity where this happens all the time, and where I also worked with for a lot, and that is electricity. It's a very interesting commodity because it cannot be stored once it is generated, at least not economically. And this is pretty much what we saw here too. We can't store it, at least not economically. We couldn't store oil in those 3 days prior to the future's maturity. Sorry. So this is an example, and there are many examples of these periods, short-lived periods of negative prices. Here, for example, that's in April of last year, but every year it happens. Every year, several days a year, there are negative electricity prices, and that has to do with abundance of green energies at some point in time. So, for example, during a very windy weather, there is a lot of wind generated electricity, which is so much that it simply overloads the grid, and people need to be paid to take that electricity off the grid. And so the inspiration for our new oil model, I think, should come from this market. So one way, I'm not going to write formulas. I actually thought about it, but I thought I'm not going to do it today. And I'm just going to talk you through possible solutions. And for formulas, I'll refer you to something which will come up later. So it's a kind of like a preview, a primer. So one thing, of course, to do is to have an arithmetic, rather geometric spot price for the first fundamental factor. So always when we look at the forward curve models for oil, we think in terms of fundamental factors, like what drives the evolution of the curve. And often this first fundamental factor is considered to be the spot price. That's kind of like a gauge of the level of the price of the oil market as a whole. So that is usually modeled as, let's say, some geometric, mean reversion or similar. So why not make it arithmetic? And that is what is done, for example, for electricity. And then once you've done that, other fundamental factors such as convenience yield, or let's say the slope or the curvature of the forward curve, can remain exactly the same as they've always been. So as a result, when you start writing down the math, you will see that the futures will be then also arithmetic in their dynamic, but option pricing, which is very, very similar to Black-Scholes, is available for normal underlyings. And there are several papers that, basically give you that kind of Black-Scholes-like solutions. So in that situations, the volatility is then what we call a normal volatility, which can be obtained from the regular volatility by scaling it by some reasonable price level. And it actually, this normal volatility has very interesting and very intuitive qualities, which reflect, also, for example, the leverage effect present in the market. So it's not such a bad thing to replace our, well-known and well-loved volatility by this normal volatility, which you can actually translate one from another. But there is another solution, which is to replace the fundamental factor of the curve completely by the level of the curve. In other words, by the average price across the curve. And if when we argued that the spikes, these negative spikes, are short-lived, very prone towards the front end of the curve, then the level of the curve still can remain GBM, that it still can remain geometric, because that will arguably not go below zero. And then you can add additional factor towards your model only on the first nearby futures contract, which is, by the way, something that we already done before several times because of many different features that first nearby contract has that other contracts do not have. And that premium factor on the first contract will allow it to dip into negative territory. In that way, the model is disturbed in a minimum fashion, and yet the negative values are can spontaneously, let's say, take place, and that first contract can be, let's say, related to the demand shock or to the level of inventories or cost of storing the oil. And the upcoming paper that we are actually describing those models and working them out. So I hope to be able to present it to you at some point in person when we meet again face to face. So with that, I'd like to conclude, and I'm very much looking forward to your questions. So I do understand my presentation today was very much twofold, or maybe even morefold, and so I'm very happy to take questions in terms of the economic trends, the consumer trends we see, portfolio implications, alternative data, sustainability, or negative oil prices. So above all, I hope I entertained you for just a small hour, and that you didn't lose your interest given all this variety of stuff. So over to you, Vincent, for the Q&A.
Thank you very much, Svetlana. So yeah, we've got a couple of questions in already. Feel free to carry on submitting. We've still got around 15 minutes. But to start off then, maybe could you tell us more about the kind of S&P and other sentiment indicators? So what alternative data was used to construct them, and how so?
Yeah, that's so this blue line basically in the beginning of the presentation, that blue line, the sentiment related to, let's say, S&P. So basically it is based on all the news items that are relevant for all the companies within S&P 500 index, and these are the news that hits Reuters Newswire. So it's not just Reuters, but 80 plus other data sources, Wall Street Journal, Financial Times, all exchanges, and so on and so forth. And all these news are analyzed for sentiment in real time using natural language processing techniques. So then you get this gigantic amount of news and news sentiment scores for all these companies and all these news items, which then are aggregated together using how novel the news are, using their relevance, how relevant they are, how much buzz is there around different companies. Still doing all that, the noise is still quite large, because of disagreement, because of the maybe error in interpretation. So then the sentinel signal is filtered, and a signal is separated from noise using techniques of, econometric techniques, rather advanced, which are especially designed for sentiment. And so the resulting index, which we call, probability sentiment indices, they monitor, S&P 500, FTSE, Eurostock index, as well as different sectors, which we can then use to assess how sectors are faring, let's say, during the crisis, but also things like crude oil and other commodities. So it's a result of looking at official news sources for many different assets, aggregating them, taking into account the news characteristics, filtering them, so denoising them, and trying basically to make sense of all this big data. Thanks for that question.
And then to kind of follow up on that, then we've had a question as well. Someone asked, fear can be measured thanks to new techniques, especially NLP, which you mentioned. However, how can one measure the digitalization and innovation score on a company? Are there alternative databases, or do you use, are there available databases, or do you use alternative techniques?
Yeah, that's a very good question. So indeed, the emotions can be measured, fear, optimism, and so on, using all these Harvard 4 psychological dictionaries and so on. And indeed, the new emerging trends, such as digitalization, or indeed a couple of other things, are as yet impossible to measure. So, for example, what is possible to do is to look for the relevant terms in the news articles, as you would do, let's say, in Google searches, and assign either a buzz indicator to that, so namely how many times is the company mentioned in relationship to digitalization, which is, let's say, comprised out of many different but similar terms. Or even trying to figure out the sentiment related to the digitalization. But I think that would be going a bit step further. So for now, we just can look at the mentioning of digitalization in its different disguises in news articles, same ones that we use to compound the sentiment score, and just basically assess which companies are at least are talked about in relationship to digitalization, in relationship to other aspects of those three trends. Sustainability, however, is well measurable and is better and better measurable as companies such as Refinitiv, Sustainalytics, and so on refine their sustainability scores. And I think many of those scores will soon start taking into account also other issues, like, for example, social aspects related to coronavirus epidemic, for example, treatment of staff and you know, hygiene and workplace practices and so on. So yeah, it's ongoing investigation, but for now it's simple word recognition, word count. Yeah.
Great. And then kind of as a follow-up to that as well, Alan has asked us, how do you filter out the possibility that your sentiment factors might be compromised by bad actors?
This is why we are very reluctant to use social media content. So everything that we do and what I work on pretty much is based on official news sources. So we want to, you know, abstract from this discussion of, you know, social media, fake news. Of course, in official news, there might be fake news too, or prominence could be given to items which are not as prominent as you think, simply for political, you know, reasons. So that's of course very possible. With social media, it's much more difficult, and that's why we just don't touch it. So that's my way of dealing with it, indeed, because it's just too hard to fish out those people you are talking about, or those organizations.
No, that makes sense. And then moving on to, well, to continue with the ESG questions, someone asked, did you think about considering joint intersections of E, S, and G scores instead of just talking about them individually? I'm thinking some effects of S that can't be seen individually can maybe be empowered by the presence of G scores.
That's a very good question. And yeah, it's a very good idea to look at the spillover indeed between the factors. So thanks for this idea. I haven't personally done that. I have several analysts, you know, that are very much into this whole ESG stuff, and that would be actually a very good question to them. So Ying, if you are watching, I'm sure you looked at the correlations and causalities between the scores. So this is something which we definitely will tell you more about. So very good point to look at. Thank you for that.
Thanks. And then another question, if you were to put together a Corona portfolio factor based on undervalued assets, how would you use your three factors?
I think I would just use it in exact same way. So basically you would go, you know, as you do another multi-factor portfolio. So you do multi-factor portfolio, you know, bottom up or top down, and then you basically include firms that score highly on certain factor, and then you refine it according to other factors and so on, or you go from so that's going from bottom up, or you go from top down in exact same way, only maybe by some sort of exclusion. But then again, so I would follow the classical multi-factor portfolio building approach, only now I would have value and those three factors, you know, stapling on top of each other. So I think we don't need to invent a bicycle here, and we can use this, the regular multi-factor approach, to combine these three trends with other factors like quality, like sustainability, I showed you already, and the value. Yeah.
And to be a little bit of a devil's advocate here, there seems to be a kind of strong relationship between the trends you talked about and the sectors. So why not just invest in the sectors that fare well given the trends?
Yeah, that of course is the number one solution. However, then you are very much exposed to those sectors, and I'm a great believer of diversification, and that's also what we always, you know, advise everywhere and always, you know, that just like you wouldn't invest in one company, you shouldn't invest in one or two sectors, but spread it out. You know, who knew coronavirus would happen? And well, except for Bill Gates, maybe. But then it basically tells us there are other things that might happen that, you know, will then the other sectors will benefit from, on top of whatever is going on now. So I'm a great believer of having well diversified in terms of sector portfolio, but then immunized for those trends and also hopefully sustainable. But yeah, the first indeed solution is to tilt yourself completely towards healthcare, communication, and tech, and seed it out basically. But you know, I wouldn't advise that.
Okay. And then we've got a few more minutes left, so please do submit any kind of final questions you have. But now to go to kind of the negative oil prices. So in light of the oil price models, would you modify crude oil derivatives pricing models and models used in risk management in the same way or differently?
I think I would modify it differently, because these are fundamentally different models. You know, it's a fundamentally different measure under which you develop them, you know, pricing measure versus physical measure. And I think that modification is fundamentally, you know, it's not completely clear to me. So I think, you know, for pricing, forward curve model would be absolutely essential and 100% fundamental to the entire operation. However, for risk management purposes, it is also very useful to have, because then you don't have to describe, you know, all correlations along the entire curve. So if you have a pricing solution for that negative situation, then possibly it could help you with the solution for your risk model under, you know, not pricing, but the real world probability measure. So I think there is certainly a spillover between those solutions. But however, I think the solutions that are sort of patchworks of solutions that are currently suggested and immediately after this event for risk management purposes are definitely not suitable for pricing, where you need to think basically deeper and in a more, you know, model sustainable way that you don't have to redo it again and again and again. Yes, thanks.
And so it looks like it might be the last question, a follow-up from the previous question on the bad actors. Someone asked, would it be possible to give less weight to less popular news websites or social media accounts and give more weight to the popular accounts?
Well, if you look at the, let's say, account of US president, it's very popular, but I wouldn't give it a lot of weight. So yes, you can do that, but then there are some pretty popular accounts, this being example number 1 and 2 and 3, which would not, you know, which the problem wouldn't be solved. So yeah, but yeah, sure, it's possible.
Lovely, thank you. Well, I think that's kind of all the questions we have for now. So yeah, just kind of just to say as well, thank you so for Svetlana for the presentation, and also to our audience as well for joining us. So yeah, thank you very much.
Thanks everyone for listening, and feel free to reach out to me in any way you want, email and so on. Thank you. Bye.
Lovely. So our second webinar of the day will begin at 4 p.m. UK time, so just in just over an hour, and we're going to have Fabio from Bloomberg joining us. So if you enjoy this webinar, please do head over to the LinkedIn page and let us know. And let's stay connected. Follow us on LinkedIn and Twitter at QuantMinds for the latest updates on our face-to-face events and webinars as well. So yeah, thank you all, and hopefully see you back shortly with Fabio joining us.